Welcome back to the Working Thesis. I am Maya, and today we are continuing our deep dive into the physical reality of the artificial intelligence boom. This is episode 2 of our series on the AI power chain. In our last episode, we talked about where the electricity comes from and how it gets moved across the country, focusing on the heavy industrial footprint of GE Vernova.
I am Theo, and it is great to be back. GE Vernova is fascinating because they're the ones actually generating the electrons and pushing them onto the grid. But there's a massive missing link in that story. You cannot just take a high-voltage transmission line and plug it directly into a rack of sensitive AI servers. The raw power coming off the grid is too wild, too volatile, and entirely the wrong voltage.
Exactly. There is an entire world of critical infrastructure that sits between the external power grid and the delicate microprocessors inside the data center. That space is governed by electrical management. And in North America, the undisputed giant of that space is Eaton. Today, we are looking closely at Eaton, a company that has quietly become the electrical backbone of the AI rollout.
When we say backbone, we mean the physical hardware that keeps the lights on and the servers humming. We are talking about massive switchgear assemblies, heavy-duty circuit breakers, power distribution units, and uninterruptible power supplies. If GE Vernova provides the raw fuel, Eaton provides the sophisticated plumbing that makes that fuel usable. It is a completely different kind of business, but absolutely vital to the same overarching trend.
And as we look at the immense capital flowing into digital infrastructure, understanding the companies that build the physical toll roads for that electricity is essential. Eaton is not building the software, and they are not training the AI models. They are simply selling the incredibly complex, highly regulated hardware that makes those models physically possible in the real world. Let's unpack how they do it.
One small thing up front. We genuinely love these companies as stories, but we're explaining them, not recommending them.
So treat all of this as food for your own thinking, not financial advice. Stay curious, stay a little skeptical, and make your own calls.
Before we get into the engineering and the business model, let's briefly touch on why Eaton showed up on our screen in the first place. When we filter for companies in this space, we are looking for very specific price action that reflects sustained institutional belief. Eaton has been exhibiting a steady, durable uptrend, trading very near its historical highs.
That kind of price action is historically one of the more reliable setups we track. When a massive, century-old industrial company is persistently trading near its highs rather than experiencing wild, volatile swings, it usually signals that the market is steadily pricing in a long-term structural shift rather than just a fleeting hype cycle. It shows accumulation and conviction.
Exactly. But as we always stress, a chart pattern is only the very first filter. It just gets the company onto our desk. What really matters is the fundamental business turning underneath that price action. If you are curious about the specific mechanics of how we screen for these trends and the exact methodology we use, we have a separate explainer video dedicated entirely to that process. We will keep the focus here on the business itself.
Right. The technical screen is just the invitation to do the deep work. And when we opened up the hood on Eaton, the fundamental story was arguably even more compelling than the chart. This is a company that has systematically positioned itself to capture the exact kind of demand that the AI build-out requires, and they are doing it from a position of deep historical strength. If we look at the broader arc of our AI power chain series, Eaton represents another classic pick and shovel play. But it is a much broader, more diversified shovel than what we looked at with GE Vernova. GE Vernova is heavily concentrated on the macro grid and massive utility-scale generation. Eaton, on the other hand, sells to practically everyone who touches electricity.
That is a crucial distinction. Eaton is heavily involved in data centers, absolutely. But their customer base is incredibly vast. They are selling electrical components to utilities that are upgrading their aging local grids. They are selling specialized electrical systems to the aerospace industry, which is increasingly relying on electronic controls over mechanical ones. They sell to heavy industrial manufacturing plants, and they sell into commercial building construction.
That level of diversification is exactly why the broader market trusts it so much, and a big reason why it trades near its highs. If there is a temporary slowdown in data center construction, Eaton is not left completely exposed. They have massive revenue streams coming from hospitals upgrading their backup power, or airlines ordering new fleets, or factories automating their assembly lines.
Right, they are essentially a broad bet on the electrification of everything, whether it is an AI server farm, an automated warehouse, or a smart commercial skyscraper. They all require more electricity, delivered more reliably and safely than ever before. Eaton is providing the underlying architecture for all of those transitions simultaneously.
It really changes the risk profile. You get the high-octane growth kicker from the artificial intelligence data center, boom. But it is anchored by the slow, steady, incredibly reliable cash flows of traditional industrial and commercial electrical management. It is a dual-engine model that provides a lot of fundamental stability in a sector that can otherwise be prone to boom and bust cycles.
So let's define what Eaton actually is today. The company has been around for over a century, and for a long time, it was known for a wide variety of industrial goods, including a very heavy presence in traditional automotive components like engine valves, superchargers, and truck transmissions. But the company we are looking at today is undergoing a massive transformation.
The core of the business now is the electrical segment. This is where the magic happens for the AI Thesis. This segment produces the switchgear, the heavy-duty circuit breakers, the power distribution modules, and the UPS, uninterruptible power supply systems. If the grid blinks for even half a second, those UPS systems kick in instantaneously to keep the servers from crashing.
Alongside that massive electrical core, they still have smaller, very profitable aerospace and industrial arms. But what is really fascinating is how they are actively sharpening their focus. Management recently announced plans to completely spin off their mobility segment, which encompasses all those legacy vehicle and automotive parts, into a separate company.
That spin-off is a massive strategic signal. By shedding the legacy vehicle components, Eaton is stripping away the slower growth, highly cyclical automotive exposure. What is left behind is a much purer, highly focused electrical and power management pure play. They are aggressively repositioning the entire century-old enterprise to align perfectly with the global electrification megatrend.
It is a classic corporate simplification strategy, and the market generally loves it. It makes the company easier to value. It focuses management's attention purely on their highest growth opportunities, and it frees up capital to invest aggressively into the electrical backbone where they already possess incredible pricing power and market share.
Let's look at the actual numbers, because this is where the AI kicker really becomes visible in the financials. According to their latest filings, Eaton's first quarter of 2026 was an absolute record breaker. They reported total sales up 17%, with organic growth driving about 10% of that expansion. For a massive industrial hardware company, double-digit organic growth is an incredibly strong print.
But the real headline was in their forward-looking metrics. Their electrical orders and backlog absolutely surged, up roughly 48% year over year. A 48% jump in backlog means their customers are frantically lining up to secure equipment for projects that are quarters or even years down the road. And according to consensus estimates and company commentary, that surge is being overwhelmingly driven by data centers.
When you have a backlog expanding at nearly 50%, you have immense visibility into your future revenue. You know exactly what you need to build and exactly who is going to buy it. Based on that overwhelming demand, Eaton raised its full-year guidance across the board. The artificial intelligence build-out is no longer a theoretical projection for them. It is showing up as hard cash and contracted orders today.
A lot of this aggressive execution is being overseen by CEO Paulo Ruiz, who took the seat in mid-2025. Since stepping into the role, he has unapologetically leaned into this specific demand curve. He recognized early that the power density required by these new AI facilities was going to break traditional electrical architectures, and he positioned Eaton to be the primary problem solver for those infrastructure bottlenecks.
Ruiz has made it very clear that Eaton will not just wait for orders to roll in. They are actively shaping how these new mega facilities are designed. By engaging with the hyperscalers, the massive cloud providers, early in the design phase, Eaton ensures their hardware is baked into the very blueprint of the next generation of data centers.
That proactive strategy perfectly bridges us to the most aggressive pivot Eaton has made recently. For years, Eaton's job essentially stopped at the server rack. They brought the power safely from the grid, through the building, and delivered it to the rack. But with AI chips burning so hot, power delivery is only half the problem. The other half is heat management.
Exactly. Traditional air cooling physically cannot handle the thermal output of a modern AI cluster. You need liquid cooling moving directly to the silicon. And this is where Eaton made a massive strategic leap. They bought Boyd Thermal, a premier liquid cooling engineering company, for about $9.5 billion. This was the crown jewel in a larger spree of roughly $11 billion in acquisitions, which also included Ultra PCS.
That $9.5 billion price tag for Boyd Thermal is a massive bet, but the logic is brilliant. By acquiring Boyd, Eaton broadened its mandate from just power to the rack to a complete grid-to-chip architecture. They are no longer just managing the electricity flowing in, they are now managing the heat flowing out. They can sell the hyperscaler the complete, integrated electrical and thermal stack.
The synergy there is incredible. When a data center architect is designing a new facility, they no longer have to piecemeal the power from one vendor and the liquid cooling loops from another. Eaton can step in and say, "We will handle the entire physics problem of your data center." Combining Ultra PCS's specialized capabilities with Boyd's thermal dynamics makes Eaton an indispensable partner.
It creates an incredibly defensive competitive position. Integrating liquid cooling with intelligent power distribution means Eaton's systems can communicate with each other. If a server rack gets too hot, the power systems can automatically adjust, while the cooling loops throttle up. That level of grid-to-chip integration is exactly what the industry needs to keep these billion-dollar AI clusters from melting down.
When you combine that grid-to-chip capability with their historical dominance, you start to see the shape of a remarkably deep economic moat. First and foremost, Eaton has an enormous installed base across North America. Their equipment has been running inside utilities, hospitals, and enterprise data centers for decades. That historical presence creates an incredible amount of institutional trust.
And that trust translates directly into switching costs. In the world of industrial electrical engineering, equipment gets what is called spec'd in. That means engineers write Eaton's specific part numbers and proprietary dimensions directly into the architectural blueprints. Once a facility is designed around Eaton switchgear, changing to a competitor is not just buying a different box. It requires completely redesigning the electrical room.
Nobody wants to redesign an electrical room. The risk of catastrophic failure is simply too high, and the cost of downtime in a modern data center is measured in millions of dollars per minute. Furthermore, Eaton has incredibly deep, long-standing relationships with the major utilities and the massive hyperscale tech companies. You cannot build those relationships overnight with a slick marketing campaign.
Add to that the sheer scale required to manufacture and service this equipment across the entire electrical stack. You need a massive global supply chain, an army of highly trained field service engineers to maintain the UPS systems, and the balance sheet to finance massive R&D. A broad, diversified franchise like this, deeply embedded in the physical infrastructure of the economy, is genuinely hard to replicate.
Of course, they do not have the field entirely to themselves. This is a highly lucrative space, and the competition is fierce. The most direct global peer is Schneider Electric. Schneider is an absolute powerhouse, particularly in Europe, and they have historically been very strong on the software side of energy management. They are a formidable rival in the data center space.
You also have Siemens, another massive European conglomerate with deep engineering expertise, though their focus is a bit more fragmented across heavy industry and rail alongside their electrical business. And then you have GE Vernova, which, as we discussed last episode, dominates the heavy grid-side generation and transmission, though they compete with Eaton on certain grid-level substation equipment.
Where Eaton really finds its edge against giants like Schneider and Siemens is the sheer breadth and depth of its North American electrical franchise. They have a home field advantage in the U.S. market, which happens to be where the vast majority of hyperscale AI data centers are currently being built. Their supply chains and regulatory relationships are perfectly tailored for North America.
And now, with the Boyd Thermal acquisition, they have added a proprietary cooling piece that forces competitors to play catch-up. While Schneider has excellent energy management software, Eaton is arguing that owning the physical physics, the power hardware, and the liquid cooling hardware is the ultimate high ground. It is a clash of strategies, but Eaton's physical footprint is undeniably massive.
We always have to look at the other side of the trade, and Eaton is not without real risks. First, despite the AI data center boom, they still carry significant cyclical industrial exposure. If the broader macroeconomy slides into a recession, factory construction slows down, commercial real estate projects get canceled, and a large chunk of Eaton's legacy revenue could take a serious hit.
There is also the reality of digestion. Spending roughly $11 billion on acquisitions, anchored by a massive new cooling business in Boyd Thermal, introduces immense integration risk. Merging corporate cultures, aligning global supply chains, and ensuring that the engineering teams actually talk to each other is notoriously difficult. Many companies have stumbled trying to swallow acquisitions of this magnitude.
Then you have to factor in the mobility spinoff. While it makes strategic sense on paper, carving out a massive legacy automotive division involves thousands of employees, complex pension liabilities, and shared IT systems. It adds a lot of moving parts and potential distraction for the management team exactly when they need to be laser-focused on the data center rollout.
Finally, there is the valuation risk. Because this story is so well understood by Wall Street, and because the company, much like GE Vernova, trades very near its historical highs, a tremendous amount of good news is already baked into the price. If their backlog growth slows down from that 48% surge, or if hyperscalers delay projects, the stock has a long way to fall to meet historical averages. Priced for perfection is a tough neighborhood to live in.
Looking at how the market is currently mapping that price action, as of early July, the stock sits just single digits below its 52-week high. The immediate momentum is relatively neutral here as the market digests the recent run-up. On the downside, market participants often look at its 50-day moving average as a first line of reference for near-term structure.
If the broader market experiences a pullback, or if the industrial sector rotates out of favor, a deeper structural zone sits lower, clustered around its 200-day moving average and the established spring low. On the upside, that prior 52-week high acts as the clear ceiling the market would need to clear to resume price discovery. Meanwhile, analysts' median consensus target currently sits just a bit above the current trading price.
As we always emphasize, these are simply reference levels that move over time as the business and the broader market evolve. They are not predictions or guarantees. What you choose to do with any of this information, how you interpret these lines on a chart, is entirely your call. We do not hold positions, we do not issue buy or sell ratings, and we definitely do not tell anyone to chase a chart.
Exactly. We are here to provide the map of how the market is currently viewing the fundamental thesis, not to tell you which road to take. The technical structure simply shows us that the market has strongly endorsed the Eaton story so far, but managing the risk of entry and exit is entirely up to the individual viewer's process.
If we have to distill all of this complexity down to its core essence, the one-line thesis for Eaton is clear. Eaton is the broadest, most deeply entrenched North American electrical franchise, and now, with the addition of advanced liquid cooling, it has transformed into a genuine grid-to-chip data center play.
It is the ultimate toll booth on the road to electrification. They do not care which software wins the AI race, as long as that software requires massive amounts of heavily regulated, perfectly cooled electricity. And right now, it is trading exactly like a company that the broader market already deeply understands and believes in.
That wraps up our look at Eaton, the electrical backbone of the AI power chain. We hope this deep dive gave you a clearer picture of the physical hardware required to keep the digital world running. Remember, distill the facts, do your own research, and recognize that this is a starting point for your own work, never a financial recommendation.
In episode 3, we are going to look at the final critical piece of the grid delivery system. We are diving into Hubbell, the company making the unglamorous but absolutely essential utility pole hardware and grid components that literally nobody can skip if they want to move power. It is a fascinating bottleneck in the power chain, and we will see you there. Okay, that's our episode. The honest goal here is simple. Hold a few ideas about the world and keep checking whether they're still true.
Together, out loud, a little at a time. If you spot where we've got it wrong, please tell us. That's how this gets better. See you next time.